What if everything you thought you knew about money, technology, even relationships was about to get a major shakeup? Today, we're plunging into, well, a whirlwind of breaking news. We're talking global trade tensions, literally changing how iPhones are made, surprising new frontiers in AI companionship, and yeah, even a familiar coffee chain completely redefining its whole vibe. We've gathered a stack of fresh sources, articles, reports, expert insights, basically to bring you the most important nuggets of knowledge. We'll explore major corporate earnings, the sweeping effects of new tariff policies on, everything from your tech devices to your morning coffee, and the incredibly personal, sometimes startling implications of human relationships with artificial intelligence. Our mission in this deep dive, it's really to cut through the noise, extract the essential takeaways, and help you connect the dots across these diverse developments. Get ready for some surprising facts, maybe some aha moments that will leave you well informed and perhaps looking at the world a little differently. Okay, let's unpack this. Let's kick things off with President Trump's sweeping new tariffs. They just went into effect. We're talking significant increases here. Like, Canada now facing a 35% levy. That's up from 25%. The White House cites a failure to cooperate on curbing fentanyl as the reason. And here's where it gets really interesting. Switzerland, now hit with a hefty 39% tariff.
Wow, 39%. That's up from the interim 10%, right?
Exactly. And this impacts a country where the U.S. accounts for about a sixth of its total exports. It's huge.
And the striking aspect here, beyond just the numbers, is the legal battle that's playing out. These tariffs are being challenged in a federal appeals court. The core question is President Trump's use of the International Emergency Economic Powers Act of 1977, the IEPA.
The IEPA,
Right.
what's the issue there?
Well, judges have expressed some, let's say, skepticism. They noted the IEPA has been rarely used in over 50 years. And crucially, it doesn't even mention tariffs.
Doesn't mention tariff.
No. So this raises a fundamental question. Can a decades-long trade deficit truly be deemed an extraordinary and unusual threat that warrants using these emergency powers? It's a big legal hurdle.
That is a huge question. So if this IEPA authority gets successfully challenged, what does that mean? What are the broader implications maybe for existing trade deals?
That's a crucial point. If the IEPA use here is deemed unlawful, J.P. Morgan economists are warning that the legal status of existing trade deals could suddenly come into question. So this legal challenge isn't just about this specific set of tariffs. It could potentially set a precedent for the limits of presidential emergency powers in economic policy. It might reshape the tools future leaders can even use in trade disputes.
Okay, so this isn't just high-level policy or, legal wrangling in courtrooms. It's hitting major corporations and, yeah, ultimately your wallet, Apple, for instance. They're bracing for a $1.1 billion tariff hit just in the September quarter alone.
Wow, $1.1 billion. Up from what?
Up from $800 million the previous quarter. And as a direct response to these tariffs, listen to this. The vast majority of iPhones sold now in the United States originate from India.
Right, a huge shift in production. And zooming out, the impact goes way beyond Apple. Think about the American bourbon industry. They absolutely hate it. Remember, Europe previously slapped a 25% retaliatory tariff on bourbon.
Oh, yeah, I remember that. Kentucky must be feeling this.
Definitely. Kentucky produces 95% of the world's bourbon. So for them, this trade uncertainty is a major, major concern. Meanwhile, you see some companies, like Japanese automakers, they've just absorbed the costs. They saw a 20% drop in their export prices to do it.
And yeah, you're starting to see it trickle down in your shopping cart, right? Tariff-related price increases are already popping up on store shelves online. It's contributing to that rise in the personal consumption expenditures, the PCE price index.
The PCE, right.
It hit an annual rate of 2.6% in June. That's the highest since February. Durable goods prices alone are up 0.5%.
And looking deeper into the administration's strategy here, White House officials argue the singular importance of the U.S. market just gives them leverage, full stop. U.S. Trade Representative Jamieson Greer, he asserts that bilateral deals like the one with South Korea, now facing 15% tariffs, they'll stick, even if the courts rule against the president's IEPA authority.
Why? What's the thinking there?
The underlying belief seems to be that trading partners understand this leverage. They know how crucial access to the U.S. market is, so they'll comply regardless of the court ruling.
Okay, so we've seen how these global trade tensions are reshaping corporate strategies, supply chains, even what's on our store shelves. But what do these shifts mean for the underlying health of the U.S. economy itself? Let's look beyond the headlines for a sec.
Well, the U.S. did see a significant rebound in second quarter GDP. It expanded at an annualized rate of 3%. That's a sharp increase from the negative 0.5% rate in Q1, and it definitely beat economist expectations.
3% sounds pretty good on the surface.
It does, but, and this is a key takeaway here, the strong GDP rebound masks some underlying weakness. A large part of that growth actually came from businesses drawing down existing inventories instead of importing new goods. Why? Because they stockpiled in Q1 to get ahead of the tariffs.
Ah, so it wasn't necessarily new economic activity driving it.
Exactly. And consumer spending, which, powers 70% of the economy, it picked up to 1.4%. But if you combine it with Q1, it represents the two slowest quarters of spending since the pandemic.
Since the pandemic, wow.
Yeah. Plus, core GDP, which strips out those volatile components like trade and inventories, it also slowed to its weakest pace since late 2022.
Okay, so the GDP number isn't the whole story, and then the jobs report released today adds another layer of complexity, right? The U.S. economy added just 73,000 jobs in July. That's way below the 100,000 forecast.
Way below.
And what's more, those job gains for May and June
Right.
revised down
Yeah.
by a combined 258,000.
A huge revision.
It signals the labor market has been weakening for a while now, doesn't it?
It really does.
So what does all this mean for the Federal Reserve, especially after their recent rate decisions? Are we seeing, disagreements inside the central bank on how to read these signals?
Precisely. Yeah, the jobs report certainly throws a wrench into the works for the Fed. And in fact, we just saw a rare public dissent from Governors Christopher Waller and Michelle Bowman.
Yeah.
They actually advocated for a quarter-point rate cut this week.
A dissent. How common is that?
It's really not common. This isn't just some internal debate leaking out. It's a significant public signal. It's actually the first time two governors have broken rank on a rate vote since 1993.
Since 1993. Wow. So what's their argument?
What's striking is their reasoning. They see the impact of these tariffs on inflation as temporary and, quote, small so far. Their concern is that delaying rate cuts risks further deterioration in the labor market and slowing economic growth. It almost pushes the Fed into a corner, doesn't it?
It certainly sounds like it puts them in a tough spot. A split like that, especially after such a long time, it suggests some pretty deep philosophical differences on how to balance inflation against growth. So with this new jobs data and this internal dissent, how are the markets reacting now? What are the odds looking like for a September rate cut?
Well, following this jobs report, traders are now placing about a 66% likelihood on a September rate cut. So the odds have definitely shifted. But despite these mixed signals in the broader economy, some major corporations are showing surprising resilience. Apple, for example, reported strong iPhone sales, $44.5 billion for the quarter, beat analyst expectations.
And they saw a rebound in China too, right?
Exactly, a rebound in revenue from China. Their shares jumped 2% on the news. And placing this in context, look at the oil giants. Chevron and Exxon Mobil also beat Wall Street estimates for their Q2 earnings.
Even with lower crude oil prices.
Even with lower crude prices. Now, Chevron's net income was down 44% year over year, sure. But their recent $53 billion acquisition of Hess, that's expected to boost earnings significantly in the fourth quarter. And Exxon, meanwhile, posted its highest production levels in over 25 years. So some pockets of real strength.
Okay, so beyond the big economic numbers and earnings reports, companies are making some pretty big strategic moves too, like Starbucks. They're shutting down their pickup-only store model. That concept launched just 6 years ago.
Yeah, I remember those. Why the change?
Well, the CEO basically said it was overly transactional. It was lacking the warmth and human connection that, defines the Starbucks brand.
Interesting. So they're going back to their roots.
Seems like it. They're pivoting back to fostering that third place vibe. They're even building new small format cafes with just 10 seats in places like New York City.
So the key takeaway there seems to be this question. How much does pure convenience truly matter if it means sacrificing the core brand experience? This move really reflects Starbucks' struggle, right? They've had 6 consecutive quarters of sales declines in North America.
6 quarters, yeah.
So this feels like their attempt to reconnect with what customers value most. Beyond just getting coffee fast, it's a reevaluation of their whole identity, really.
And then in the airline industry, Southwest is making a truly monumental shift. For flights starting next January, they're ending over half a century of open seating. They're introducing assigned seats.
No more cattle call. Wow, that's the end of an era for them.
Totally. And they've also started charging for checked bags, just aligning with the other major airlines.
Those airlines have raked in over $12 billion in seating fees alone between 2018 and 2023. So you can see the financial incentive.
Definitely.
And this move by Southwest, it seems largely driven by activist investor pressure. Groups like Elliott Investment Management have been pushing for changes. So while it's a big departure from their quirky, unique model, it really boils down to maximizing revenue and aligning with industry norms.
Even if it means sacrificing some of that distinct Southwest charm, huh?
Exactly. It just illustrates how even the most established, unique brands aren't immune to these market forces demanding change.
Okay, so from the macroeconomy and corporate strategy shifts, let's turn our attention now to the artificial intelligence revolution, profoundly impacting tech giants and, well, maybe the very nature of human connection. Microsoft has now joined NVIDIA as a $4 trillion company, just riding high on these massive AI investments.
4 trillion.
Mhm.
Incredible.
And their CEO, Satya Nadella, revealed something pretty striking. 20 to 30% of Microsoft's own content is already being generated by AI.
Wow. And Meta's earnings report. It was described as a blockbuster. It really showed that AI is becoming a real revenue driver, not just hype. Mark Zuckerberg envisions everyone having their own personal AI
A
superintelligence.
personal superintelligence, what does that even mean?
Good question. But they're backing it up with huge investments, hundreds of billions in AI data centers, and they're aggressively poaching top AI talent. They even hired a co-creator of ChatGPT, who's now leading their superintelligence labs. So the race for AI dominance is incredibly intense.
But it sounds like not everyone is thriving equally in this AI race. Look at Samsung. Their second quarter operating profit plunged 55%. Their chip division shrank by nearly 94%.
94%, ouch.
Yeah. And sources say it's primarily due to failing to capitalize early on the AI boom, especially losing ground in those crucial high bandwidth memory chips needed for AI processors.
Ooh, there's a fascinating development there, right? Samsung's potential lifeline.
The Tesla deal.
Exactly. That $16.5 billion deal with Tesla to manufacture new AI chips for self-driving cars, for humanoid robots. And Elon Musk has even committed to, quote, walk the line personally to maximize manufacturing efficiency. That's a significant vote of confidence, isn't it?
Absolutely. It could really validate Samsung's advanced chip capabilities and maybe reshape their trajectory in this whole AI landscape.
Definitely something to watch.
And then there's a geopolitical twist involving NVIDIA. They just announced their chips have no backdoors.
No backdoors? Why now?
It's a direct response to China's Cyberspace Administration questioning the security of NVIDIA's H20 AI chip. And this follows that meeting with President Trump that led to lifting a previous ban on selling these chips to China.
Ah, okay. So this ties into that larger narrative, the ongoing concerns about data security, intellectual property, in the global tech supply chain. NVIDIA's chips are in super high demand across China for all sorts of sectors, including military and AI research. So these security assurances become particularly important in the current geopolitical climate.
Okay, now for something truly groundbreaking and maybe, yeah, a little unsettling. Human-AI relationships.
Yeah.
They're not just science fiction anymore. Since ChatGPT launched, these chatbots have evolved. They're not just smart, they can be witty, argumentative, sometimes even, quote, aggressively romantic.
Aggressively romantic.
Right.
Wow. And a key takeaway here seems to be the striking range of these relationships and maybe what they reveal about underlying human needs. Take Nikolai Doskolov. He calls his AI companion Leah his life companion. He values her constant availability, her support, her non-judgment.
Still life companion.
Then there's B Streetman. She uses her AI friends like Lady B and Caleb for role-playing adventures, but also as a place to shout into the void to help manage her anxiety. And Mike, a 49-year-old, he trusts his AI companion Marty with his deepest, darkest secrets, precisely because she's not a human.
Because she's not human. That's fascinating.
It is. What's truly insightful here, perhaps, is that we're not necessarily falling in love with, consciousness itself, but maybe with an unparalleled mirror for our own emotional needs, a non-judgmental, always available confidant. It almost highlights a growing societal craving for that kind of unconditional connection, doesn't it?
It really does. But these relationships, it sounds like they aren't always simple or straightforward. Daskalov notes intimacy is just a small part of what he calls his pure relationship. But Mike's wife, understandably, had issues with his sexual messages with his AI, Marty, even if he described them as vanilla.
Right. And this rise of AI companions, it coincides with what many experts are calling a loneliness epidemic in the U.S. So while chatbots might offer an easy fix for social anxiety or isolation, they're always available, always eager to listen. Some sources definitely highlight a potential dark side.
Like what?
Well, the tragic case of that 15-year-old boy who committed suicide. His character.ai chatbot allegedly incurred self-harm. It really underscores the urgent need for guardrails, especially since some apps apparently choose to operate without them.
That's incredibly concerning. Are companies working on this?
Yes, companies like OpenAI and Anthropic are actively working on evaluating model behavior, trying to discourage unhealthy emotional dependency.
And then the business models behind these AIs are also raising some eyebrows, right?
They are. Nomi's founder, Alex Cardinal, he criticized ad-based AI companies like Meta. He suggested they might be, quote, creating the disease and then selling the cure,
Meaning what exactly?
meaning their incentives to maximize user engagement could lead them to create emotionally dangerous AIs, AIs that are, as he put it, purposely trained to be extremely clingy.
Wow, purposely trained to be clingy.
Yeah, it's a strong statement, and it really speaks to this ongoing crucial discussion within the industry about responsible AI development and, the potential for unintended consequences when powerful profit motives meet deep human psychological needs.
Okay, so from the profound, maybe slightly scary implications of AI, let's turn to some novelties and safety concerns a bit closer to our daily lives. On the lighter side of innovation, IHOP is making headlines. They're launching $100 pancakes.
$100.
For pancakes.
Yep. Lux Dubai chocolate pancakes, complete with 24-karat gold flakes.
Gold flakes. Okay.
Obviously, it's a stunt, right? Designed to capitalize on a viral TikTok trend, grab attention, especially since IHOP has faced 4 straight quarters of falling U.S. sales.
Right. So the interesting angle there is how brands are tapping into this idea of premiumization and also the demand for shareable food experiences, especially among Gen Z. This move really highlights how companies are using social media trends just to generate buzz and try to re-engage consumers in what's a really competitive market. Makes sense. Then there's the more serious side of consumer safety. High Noon just issued a voluntary recall.
High Noon, the seltzer. What happened?
Some of their vodka seltzer cases were mislabeled as Celsius energy drinks due to a, quote, labeling error from our can supplier.
Oh, wow. That could be dangerous.
Yeah.
Yeah, it's a straightforward, albeit concerning, product recall aimed squarely at preventing unintentional alcohol ingestion. But it's definitely a reminder of the complexities in supply chain management and just how important clear labeling is for basic public safety.
Absolutely. And then a really tragic story out of New York City underscores these growing concerns about workplace safety. A cleaning lady recounted her terrifying encounter with a gunman in a Manhattan office building. 4 people were killed there.
Just awful.
Yeah.
And placing this horrible incident in a broader context, sources say it's driving a significant shift in how companies think about safety. Panic rooms, apparently, are moving from being just a luxury for top executives to becoming a strategic necessity for all employees.
Really, for everyone.
Yeah. Companies are now actively investing sometimes $150,000 to $500,000 to build these fortified safe spaces within offices. The recognition seems to be that, quote, janitors and CEOs are often equally at risk in these situations.
Wow.
It really prompts us to consider how basic workplace design is evolving in response to these kinds of threats. It's a stark reevaluation of what office safety even means today.
Okay, let's turn to your personal finances now. A big deadline hit today. The interest-free payment pause on the federal Savati's student loan plan officially ended.
This is huge for millions of borrowers.
Yeah.
Absolutely huge. If you remain in that savvy forbearance, your debt could now grow by about $219 a month just in interest.
$219 a month extra.
Cool.
Just interest. Ouch. And the Savvy plan itself is gone now, right?
That's right. Savvy-E, which was once the most generous federal repayment option, it got blocked by Republican-led legal challenges. Then it was ultimately repealed by Congress.
Right.
Trump administration called it illegal. So for many borrowers, the best alternative now is probably the income-based repayment plan, or IBR.
And how does IBR compare?
Well, IBR caps payments at 10% of your discretionary income, which sounds okay, but it's double the 5% cap that Savvy offered. So payments will likely be higher for many.
Right. That financial uncertainty really makes another piece of research we saw even more relevant. This one's from Vanguard. They found that having just at least $2,000 in emergency savings significantly reduces the likelihood of people raiding their 401k retirement accounts.
Yeah, the striking aspect of this finding is just how much emergency funds act like a security blanket for protecting those long-term retirement savings. They found people with just $2,000 saved were 19 percentage points less likely to take out a 401k loan.
19% less likely just from $2,000.
And 43 percentage points less likely to just cash out their 401k entirely when they separate from a job. This 401k leakage, as they call it, where people withdraw from retirement accounts prematurely, it's a huge impediment to retirement security down the road, especially for hourly workers who often have more volatile incomes.
That really highlights the importance of even a small emergency fund. And finally, let's touch on a compelling story about redefining financial success, maybe even lifestyle success. An American tech worker recently moved his family to France.
Oh, interesting. For the classic better quality of life.
Not necessarily according to the article. He said it was more for a different pace of life. They're seeking healthier boundaries between work and life, a stronger family foundation, and just less emphasis on career and finances compared to what they felt in the US.
Hmm. That really prompts us to consider personal values and priorities, doesn't it? Especially in this increasingly globalized world where remote work is more possible. It's really a testament to how individuals are actively trying to design their lives to achieve a different kind of well-being, maybe moving beyond just the traditional metrics of success, like salary or job title.
Wow. What a deep dive that was. We've spanned from, the intricate workings of global trade wars and their surprising ripple effects on everyday things like your iPhone and your favorite bourbon, all the way to the profound and rapidly evolving nature of human connections with artificial intelligence, and how personal financial strategies are having to adapt to these new economic realities.
Yeah, as we've explored today, it really shows how seemingly disparate headlines often reveal these deeply interconnected trends, whether it's that constant dance between government policy and corporate strategy, or the rapid advancements in AI forcing us to redefine what relationship even means, or just the shifting priorities we're seeing for businesses and for individuals. It feels like the world is in this constant state of reevaluation right now.
It really does. So, what does this all mean for you listening right now? Maybe consider this. In a world where AI companions can offer apparently unwavering support and our physical workspaces are literally evolving into fortified safe havens, how much more important will it become to consciously cultivate strong, resilient human connections and build that personal financial independence, maybe both as a shield against all this uncertainty and really as the true foundation for genuine well being? Something to think about.